Good afternoon, everyone, and thanks for joining this panel today on investor perspectives in biotech. My name is Brendan Singleton. I'm a managing director in the Equity Capital Markets Division at Bank of America. I focus my time on helping biotech companies raise capital. Joined by my co-moderator, Anthony Yu, who's a managing director in our investment banking division. We have a great panel lined up today with three of the most influential investors in the space. Collectively, this group manages north of $50 billion in assets. So a significant number when you think about it in the context of the broader space. Today we'll start off by talking about what's going on in the current market, some of the micro influences that are shaping the space, and then we'll end with some perspectives on what we expect in the years ahead. So I'll start with a question for all of the panelists to weigh in on. We're sitting here, markets at all-time highs. There's been quite a few changes as it relates to regulatory and geopolitical aspects of the market. So when you think about, maybe I'll start with you, Rajiv, when you think about where we are in the current cycle versus the last few years, how would you contextualize where we are in the cycle?
So the way I think about it is that, let me just go back a little bit in recent history. 2020 was a very big year for biotech. Interest rates were zero. The vaccines heralded a period of optimism where a lot of the work done over the last several decades was translating. It took 9 years, took 9 months. And the world came out of a major health crisis. It also drove a lot of exuberance in the space. I think a lot of companies came public given the low interest rate environment and the enthusiasms of sort of a new golden age for science. And that led to a bubble, I think, for that period. And the last few years has been working through the after effects of that period. Interest rates went up dramatically. A lot of companies that were probably shouldn't have come public based on very early on science and not properly funded you were public companies trading as public companies, and and in the last period, there's also been the rest of the market, which has been very AI focused, so enthusiasm away from biotech. So I would say it's been a pretty serious bear market in biotech in the last 3-4 years. My hope is that this is creating an unprecedented opportunity for investment. At some point in the last few years, about a third of the biotech companies, there's about 600-700 publicly traded biotech companies, about 60 to 80 new companies started every year, several hundred private companies, and that's the scale we're talking about. About a third of them were trading below cash and had negative enterprise value. So from an investor's perspective, if you were able to have the capital and survive the early harsh years of the 21 downturn, this has really been an amazing period to buy some of the best next generation science at historically low prices. Some of the smaller emerging companies at some points in the last few years traded on an EV to cash basis that was below the bottom of the dot-com cycle in 2003. So very bearish sentiment in the biotech sector. More recently, with interest rates maybe coming down a little bit and a normalization of the supply demand, I think money in the sector has flowed more rationally in the last period. That's created a lot of opportunities for companies with data to get funded. We know that the big pharmaceutical companies have a lot of cash on the balance sheet at a much lower cost of capital, and there's about $500 billion worth of revenues coming off patent in the next 7 years, and they rely on these smaller companies, the biotechs, the companies that, the private and the public companies that we invest in for innovation. And clearly, the innovation lies in the biotech sector, and then you've had the macroeconomic, and the macro sort of political turmoil in the whole healthcare sector in general that we've talked about in the last few days. So that's been another headwind for the sector. My thought here, and I'll conclude in a few seconds, is that despite all of these headwinds, and despite this sort of bearish period, the fundamental need for breakthrough medicines is undeniable. I think we all agree on that, no matter what side of the aisle we're on. And the United States has a leadership capacity in the world for this. Boston, Cambridge is the center in the world for innovation still in biotech. Of course, other parts of the world are catching up, and maybe there's room for collaboration. I feel that the basic science is advancing. Despite the challenges, in the near-term challenges, the longer-term 20-year trend is greater resolution, subatomic space into cells, the different components within the cells, cellular networks, great ability to understand those network effects and really solve major fundamental health problems on a very causal foundation, and really move patients and save a lot of dollars for the healthcare system if you do that as well through real breakthrough type therapy. So I'm very optimistic about, from an investment perspective today, just given the ideas I have, and this is purely based on a bottoms-up perspective. So I spend all my time, Fidelity is one of the biggest biotech investors in the world, and we get to see most of the companies almost every day. And so I spend all my time not pontificating on a big picture, spending more time with individual molecules and management teams and looking for those breakthrough drugs. And so if I think about this, take a step back and think about it from a top-down perspective, it's very easy to get freaked out. But when you look at what's going on a foundational basis, on a fundamental basis, with a lot of the companies that are innovating rapidly, I think there's reasons to be very optimistic.
Ricky, maybe anything to add from another?
I feel inspired. It's Rajiv talking. Wow, I hope you're right.
Cool.
I would say one of the things I learned over the last decade or so, I didn't realize this. In fact, biotech investing has one major macro theme that's correlated. It's actually interest rate of all things, right? Because we have cash-starved young companies, and so borrowing costs is actually one of the principal drivers by which, how a lot of the public investors invest. And, we have been waiting for the IPO market to open for, I don't know how many years now. I think maybe, the next year may be the year. So I would say is I remain very optimistic. I think one thing Rajiv said, which resonates with me, is that I do think the pace of innovation has really accelerated. And what you may not see is that, sometimes when we push too hard, right, everything gets public and we create too many companies, there's a digestion period. But I also think that now you have a period where the incubation is actually prime time ready. So you are going to see companies that progress forward. I feel optimistic that I think if we just keep on doing what we're doing, things are going to go well for us.
If you have drugs, molecules that work, most things still fail. You can't forget that. It's a very hard business in that way.
I agree with Rajiv and Ricky. I think definitely we've gone through a digestion period. I think that's probably behind us. It does look like market is in a stabilizing period. I think market is actually quite differentiating. And we're just not in an environment that rising tide lifting all boats. But if you look at the equity evaluation, there's actually quite wide range. And companies with very differentiated assets, first and best in class, that address very clear unmet medical needs, those actually rewarded by the market in quite nicely way. So I think at the end, it's really down to individual program and individual assets. I do think there's a silver lining about this, just the last few years, a very tight capital environment. I think it probably forced companies that really think hard what programs to prioritize. And whoever's really, I think the surviving companies, I would think in general, have probably higher quality programs than, let's say, several years ago, just given, the whole industry needed to respond to the tight capital market environment. So I think it does set a floor, and and I do think, going forward, things should improve.
Maybe along those lines, just in terms of public versus private market investing dynamics, how do you see those at the moment, and are those, the gap between those two widening, narrowing? Any key themes that you would call out? Maybe we start with Erin this time.
The public private?
Yeah.
I I think the public market still, I think the valuation is still pretty subdued, and as what Rajiv and Ricky talked about, the IPO market, has been pretty subdued. We just started to see some activities. As a result, I think the public market valuation is actually quite attractive, whereas in privates, we've seen a lot of the down rounds of the valuation, but I would say in general, the public market probably price companies more efficiently than private market. And private market, I would say also there's a pretty wide spread of valuation range. The high quality ones tend to get capital easier and have relatively higher valuation versus some of the companies that could be more. So I think in general, biotech, it's just hard to really make a general statement because at the end, it's really about individual companies and the programs. But I think at this point, just given where the public market is and just what we've come through, I still think the public market valuation is quite attractive.
I agree. I think from a private market where we spend more time in, there's always this idea of, well, the current investors don't want to mark their investment down. So there is a period of time, there's a struggle for the company to continue to fund themselves as much as they can before they cannot do it anymore. And so on the private side, what we see more of is these days is that, hey, the investors or raising new rounds, they're not just looking for a small round they can get to maybe the next value inflection, but they're really thinking long and hard about what can you do to go all the way to the finishing line. Could be as dramatic as going all the way through phase 3 and registration, right? Because in the past, you would never think about this. But today, because of lack of IPO market and lack of other means of financing, these has really come into boardroom discussions.
I agree with Ricky and Erin. I would just add that I think I've stopped thinking about investing in these terms, in these silos. Public versus private, phase 1 versus phase 2, disease categories. Those things those lines seem arbitrary and sort of old-fashioned in my mind. What you really want to understand is the pathway, the molecule, the target, the cell type. And when you're able to engineer cell types with a high degree of granularity and resolution, you're going to find applications in a lot of different diseases. And when I think in those terms, for me, the key criteria are high probability of success. And another important thing, which is very hard to do in biotech, because most drugs have great science and very promising, but take a lot of money and fail. And that unfortunately hasn't really changed. And that's sort of the hard challenge of our industry at this moment. Maybe machines one day might help with that. But for the next few years, I think we're going to have to deal with that challenge. So I think you've got to think about molecules individually and not sort of make these arbitrary distinctions. The second thing, besides probability of success, I would think about is a sort of monopolistic businesses. And it's very difficult these days to find a breakthrough drug that can actually have exclusivity for a long time. If you look at the last 30 years of the industry and you look at the big companies, Gilead, for example, with HIV, they were a monopoly. Celgene and Revlimid was a monopoly. Alexion and rare diseases was a monopoly. Originally, Amgen, when it was built with Epogen and Neupogen, those were both monopolies. And it's a long list. The insulin companies sort of monopolistic. It's very difficult to do this now, I think, because the amount of money that's been raised by venture capital, plus Chinese companies in other parts of the world, are very fast followers. And the moment you have a breakthrough, and the pharmaceutical companies also, tend to be. Some of them are more innovative than I would have thought, maybe 5 or 10 years ago. But it's the 10th PD-1 and the 15th GLP-1 that's crowding out the clinical trial space and the capital raising space. So I'm looking for high probability of success, monopolies, and the third thing is a bit of an idiosyncratic thing, which is founder-led companies. They historically, just across all industries, they just seem to outperform by huge amounts in the long term. And so if I can get companies that meet those three criteria. Valuation, I guess, is the other thing too. And what's good about this depressed market is you can get a lot of good valuation opportunities. So if you put all those things together, and like we discussed earlier, there's about 1,000 companies there. If you invest in 20 or 30 of them, those are going to be the next generation breakthrough companies. But it's easier said than done. It's very difficult to predict these factors with a high degree of precision. And I'll buy them if they're private or public, because that's where those are the gems.
So Ricky, you mentioned, I'm going to single you out because I think you mentioned that the IPO market was going to come back in 26. We just saw our first IPO after a 6-month hiatus with LB Pharma. Do you think that next year is the year? I feel like we've been saying this for the past few years now, but what do you expect the IPO market to look like?
You should now listen to whatever I have to say. I have no track record to prove that point. That's point number one. I remain optimistic, but I actually think about this as, look, usually if you think about the last cycle where we saw this was really around 2014 and 15. After 2008 happened, there's a wave of like a dearth of real biotech IPOs. So imagine how long it take from going from an interesting idea to actually having a molecule that is through proof of concept and perhaps also in late stage or even in the regulatory approval. It takes a long time, right? 7-8 years is very natural. So therefore, I feel like a lot of the good ideas that were ideating during the 2015 to 20 takes a while to get there. And so if we say, hey, what happened in 2021? The world went on fire because we weren't ready and we went out. That was where things went into trouble, right? Now you've been waiting for another 4 years. You would imagine some of that Rajiv said, well, maybe they have good molecules, would have graduated by now. And so you're starting to see the quality will get better. Because now everybody else is holding back. They don't want to come out until they're truly ready. Guess what's going to happen? The quality will go up. And I think, a lot of the, I'm sure the banking team all saw whatever the quality of these private companies are. And so I do think there are going to be buyers. Rajiv here is chomping at the bits thinking about, hey, what's the next interesting company, private or public, right? So that's kind of my perspective. Could be wrong.
I do think market actually has pretty good appetite for companies with good clinical data. And we've already seen that, right, regardless of whether it's IPOs or secondaries or just the daily trading in the market. So I think in a way, it's kind of simple. It's really about the clinical program, the quality of the assets.
Yeah, I would say I have no idea. It's very difficult to predict what the market's going to do. But if you invest in good companies based on the fundamentals and you're able to get those breakthrough molecules, the market environment should just be an opportunity if the market's on sale. And if it's not, you're going to get rewarded. So you've got to be aggressively looking for this and doing the work. And if you just look back over the last 30 years, I'll give you one example. Gilead's HIV drug, the first one, in 98, long-term capital management went bust. Greenspan cut rates to zero. It gave rise to the dot-com bubble and the genomics bubble. And I was at the FDA panel meeting for Gilead's first-generation HIV drug that had a kidney tox signal. And I was very confident that they would approve it because it was approved for compassionate use. This is in a really roaring bull market for biotech. And the panel voted against it. The stock was down 70%. It went from $1 billion to $300 million in a day in the middle of a super bull market. It just goes to show if you get the fundamental wrong, there's nothing the market's going to do to save you. The flip side of it, the next generation drug, they dialed out that kidney tox. That drug got FDA approval right before 9/11. The market was tanking. The genomics bubble was crashing. There was a lot of macroeconomic turmoil. And Gilead went from $1 billion to now it's $100 billion. That decade, it became the best performing stock in the S&P 500 because of Myriad and the HIV combinations that came from there. So it's just, and I have tons more examples. I don't think we have time to go through this, but, and it's true across other industries too. We look at tech, when you have great companies, they trend to come out of periods of depression or financial recession like we've been in the last few years in biotech, so I'm hopeful. I think the valuations are also favorable in that sort of a climate, but it also forces what you were saying, kind of the best to survive and thrive. And those companies that really shouldn't be around can't make it. And so, to your point, it is an environment where data is getting rewarded. And I would say that's a fundamental theme that's decades long in biotech. If you've got great data, I really don't care where the interest rates are or what the S&P 500 is doing. Society is going to need those drugs, and there's going to be value for it. And I'm still hopeful that the United States will pay for it.
I thought Rajiv made a very interesting point about investing and thinking through opportunities beyond kind of these arbitrary designations of phase of development or therapeutic area. I'm curious about our other panelists if they take a view in terms of therapeutic areas, stage of development, or modality, delivery technologies that are involved, or are there any particular dimensions that you look for in investing these days? I'll start with Ricky.
We are a therapeutic area agnostic. Stage-wise, I do think that we're trying to we're data junkies, so it's got to have some data. So I think I will not go for a piece of paper or concept. That's not where we spend most of the time. So it's got to be after a development candidate. So there's some data, and ideally, starting to moving into the clinic, so we can really help the company think about how to do clinical development and the commercial plan in the future. So that's kind of where we spend most of our time. I would say in terms of what areas are interesting to us, everything is interesting, but I think my personal affinity are areas of what I call it usually forgotten or cold. I think the good investors usually identify things where people thought was forgotten or not as interesting, but as investors or as company builders, we found could be the cusp of breakthroughs. That's where you find the most value.
Yeah, we're also therapeutic area agnostic. I think there's a reason for that, right? Because our objective is really to identify really attractive companies from equity perspective. And it's very innovation-driven, product and program-driven, and really just, I think, across therapeutic areas, there's actually quite intense innovation. But on the flip coin is, as Rajiv talked about earlier, there's just a lot of competition as well, so which makes the job more complicated these days. But in general, I think there's still very strong innovation in oncology. This is still an area where the largest R&D dollar is allocated in pipeline development. And next few years, I think there will be quite a few phase 3 readout and also continuous data generation that I think will still make oncology area very, very interesting. Immunology, I think, is also a very interesting area, and it's a market with multiple diseases and very strong growth as well. These tends to be chronic market and looks like patients just cycle through different mechanism of drugs. So I think this is also an area that we're very interested in. And modality-wise, I think we're also agnostic. I think if you look at cancer, right, this is where the different modality tends to be all converge at the same time. And it's also very competitive. You have small molecule, cell therapy, bispecific, ADCs. And very often they all go to the same disease indication. So it's really about identifying which could be the winner. I hope the next number of years neurology could have some really great breakthrough. I think if I look at across therapeutic areas, cardiology all these decades, right, we've had great advancement. Oncology also, and immunology, but the neurology is still somewhat very high-risk area. To some extent, it's limited by delivery methodology, and it does look like there's advancement in brain specific delivery technology improvement. So I'm hoping that next few years, this will be more productive area for both the industry and from an investment perspective.
Maybe shifting the conversation to the regulatory environment. I'll start with you, Rajiv. When you think about deploying capital in this market with all the changes occurring, in this landscape. How does that factor into your ability to put money to work?
Again, I just go back to the thought we had earlier, which was that you've got to try and find that breakthrough molecule. And the treatment effect, you don't have to debate the treatment effect when you have that. And I try to stay away from those debating zones as much as possible. So, it's obvious to everyone. And I think, if you've got a breakthrough drug, you're just going to get approved, and most likely you're going to get a socioeconomic payer environment that's going to justify it, given saving costs and improving outcomes for humans. So I don't, I sort of take this like crazy long-term view as well. I was listening to what Erin and Ricky were saying, and I agree with that. And if you think about it, and I'll put this in to answer your question, the regulatory environment, I say, to me, it's changed so many times in the last few decades. Who knows what it's going to be like in the next 5 to 10 years. Again, I think if you have drugs that are breakthrough, they're going to get approved in any regulatory environment, certainly in the current regulatory environment. There is an emphasis on having access to cures and breakthrough type therapies, despite some of the other controversies. So, and the biotech industry has made tremendous progress in the last several decades, from protein replacement therapies to antibodies, to targeted small molecules, and this is a great moment. And then all the drugging and modalities, drugging targets on DNA, RNA, protein. And it's a great moment when chemistry and biology are meeting in so many different areas. And the machines and the possibility to really explore chemical space in a way that we haven't done before. I saw Roger Perlmutter sitting here earlier, what his company is doing with high-resolution electron microscopy is really groundbreaking, able to visualize atomic and subatomic space within cells, real time, simulate that, and dynamically, watch these protein folding and assimilation take place. So AlphaFold. So there's all these amazing things that are going on, and I'd much rather spend my energy on that and trying to work with those tools and those companies to try and move the field forward. Because despite all this optimism around technology, I'll also give you the other side of it, which does frustrate me. Yes, it's true there's been progress in cancer, but there's really not been much progress in cancer besides a few targeted therapies that have helped a few thousand patients. Granted, some investors have made a lot of money out of it by charging a lot of high prices and moving the needle for those patients, definitely. But broadly, PD-1s have been around for a long time now, and everything around PD-1s have failed. So I would say, from that perspective, and there's been a lot of money been put around it, and the hope was that with engineering T cells and opening up the immune system, you'd be able to really crack the tumor microenvironment for solid tumors, and that hasn't happened. And the dollars are shrinking in that effort. So that does concern me. So, and that impacts the vast majority of millions of Americans living with cancer today and the aging population. So, that's the frustrating part of all this, that besides all the great fundamental science and the great opportunity set and some important breakthroughs, we've still got a very long way to go.
Ricky, Erin, anything you'd add on that?
Yeah, I would say because we're slightly different as, mostly as a private market participant and also, company builder, we do get closer to, being on the board or involved advising management. One of the things we spend more time thinking about in this environment is that, you have new administration, and so come with it in a new FDA, for example. And so for us, it's really about, engaging them and really preparing the management team. So to prepare for, if there's any delays, and what are you going to really do from a balance sheet perspective, from a strategy perspective. Those are things that we have to get more proactive. I agree with Rajiv, what you said is look, longer term, if you have breakthrough therapy, there's unequivocal results, I don't think we need to worry about this. But when you start to have results that's, okay, maybe we need to have a discussion, the question is, would you have those discussions readily? And how would the agency really guide you? These are things that, I think we're all going to try to figure out over time. But I'm optimistic that, these things will be resolved over time because, when you have a change of different people within the agency and the working teams. Of course, there's going to be some disruption. That said, I think you all see there's still drugs being approved, right? So that's still going on. So we're optimistic.
Yeah, I think we've actually seen timely approval on products, especially those, I would say, relatively straightforward, similar to what Ricky talked about. Very, if you look at a data package, right, very few questions, and those tend to just have easier time.
So we,
I'll just say, we're still only approve around 50 drugs a year. But that number's been flat for 20 years, I think, between 40 to 50 drugs a year. And so, I go to a lot of science meetings, and it's exciting when there's one new gene being discovered every day, and there's 10,000 diseases where you think you understand the causal drivers of the disease. But if you only have 50 new drugs a year, it's going to take several hundred years, 200 years plus to make drugs for the disease where we think we already understand the causal drivers. I mean, that's not acceptable, I think, for anyone. So I don't know, I hope the regulators and the FDA can challenge us to do better, and I hope that we can find a way to try and translate some of this biology and faster. So working with the industry, I think, is a very positive. One more aspect, I think, that we'd hope that you would see with the FDA. There's signs that these drugs are being approved, and that the FDA is proactively reaching out to companies and reaching out to different players in the industry to try and work with the patient groups and the companies to try and expedite some of this from happening. That would be really welcome if that were to fully translate.
So maybe, we have 5 or so minutes left. We have a lot of operators in the audience, and industry participants as well, but it's a tough capital markets environment to navigate when you're thinking about raising capital. Erin, you made the point that it's causing a lot of companies to kind of right-size their focus areas, but what would be some advice that you might give to the folks in the room about, how to navigate the current market climate? Erin, I'm going to start with you.
I think from investor perspective, what I like to see companies just be really thoughtful about capital deployment and just make rational and really thoughtful decision. It's easier said than done. But when you think about if you want to develop a drug in a highly competitive area, and you probably see a lot of questions from investors like, what do you think is why do you think your program is differentiating if you're not number one and you're behind? So I think that at the end, it's really about whether the decision to spend on a particular program is, really make a good sense. So I think because we've seen a lot of companies, right? There's really, I think, a gradient of capital deployment decision making, and I think that's actually a very important aspect that we look at, and just really hope the companies take that into consideration.
Ricky?
3 points. This is what I have to talk to management board all the time. Number one is spend discipline, Erin talked about, because I think if you look at back 2015, I don't know if people track this, maybe you guys do, 10 years from 2015 now, I feel like every cost of doing business in our ecosystem is double or more, right? That's not helpful because we're a cash-starved company. So have to spend discipline and focus on the critical path. That's point number one. Point number two is choose your investors wisely, because I think what's private or public, having the long-term support is critical because you don't have to suffer from the short-term fluctuation of capital base. And the third is really about thinking long-term, because at the end of the day, you're not looking for the next year or 2 years. You're looking for ways to develop a drug and ultimately commercializing a drug. That's ultimately where everybody's looking for to do, right? This is where you make real contribution to society, so make sure you have that goal in mind.
Can I add one thing? I think, for private companies, right, they going IPO is definitely a major milestone, and congratulations to all of those who become public. but it's really just one step. And then being a public company is really a long journey. And once you're public, you really expose yourself under the sunlight, and you get scrutinized. And so, which really, I think, require companies to be pretty careful in a few things, right? The communication style, I think market tend to like under promise and over delivery. I think sometimes we see companies, translate their own enthusiasm into expectation setting that actually tend not to end up, being in the right place or in the desirable place from a public market perspective. And then the other aspect, the spending we talked about, and then just the because it's public, and the execution in terms of tolerance for misstep in execution is, especially in a tight market environment, is actually not really high. And it really requires company to be pretty careful planning. If you're running clinical study, make sure you're on top of the programs, make sure all the clinical sites, no mess up and things, because every data points that you generate leads to a stock price, and then that's where you raise capital, and then that will really fund you to the next step. And if you have a misstep, there's certain things that companies probably can't control, but for things that companies can control, I think really require very close eye on the operational perspective, because every step on the way, you do need to raise capital and need to fund the company and move the company forward.
Rajiv?
I don't have anything to add to that. Those are all great ideas. The only thing I could say that's not advice is just a sort of a note of commiseration, which is that I have a lot of respect, and I think we all do as investors, for those entrepreneurs that are trying to build biotech companies. It's one of the hardest things to do in the world. It's a very important thing to do for all of us. And, a lot of this is out of our control, the capital market cycles, et cetera. Things will get better. It always does. It might take longer than we hope. It sometimes takes longer than we'd like, so you can't time it. But I would just say the notion here, I think I would speak on behalf of Fidelity as well, is that we want to collaborate with the best entrepreneurs. If you have great ideas and you have great molecules, the door is open. And I would love to engage in an active dialogue, and at the right time, maybe we can join forces. But I have a lot of respect and compassion for leaders and entrepreneurs that are trying to build these amazing companies that, for the most part, are trying to do the right thing for people.
Well, I want to thank each of you for taking the time today. Erin, Rajiv, Ricky, it's been a fantastic panel, so we appreciate you making the time.